Well, that was a year ago, as you said, and I would actually argue that you're starting to see a healing in the private sector labor market. Now, a war, to be sure, will curb business confidence, but wait a second. I just got a bunch of business confidence surveys, a group of manufacturing surveys through March, which captured the war and the increase of the price of oil, and their employment indices actually rose.
Yeah.
So I think you have to look at the economy broader than just a war and increase in the price of oil.
I look at the Guadalcanal low, how miserable we were in 41, 42, into that battle in the South Pacific that we didn't want to talk about at the time. And then up and away we went basically for years into the deflationary 50s. I guess. Is it the same thing as well that this war could be a stimulus of sorts?
I'm not sure the war itself is a stimulus, other than the backbone of the U.S. economy is indeed strong. We've had surges in the price of oil several times over the past 30, 40 years. Obviously, in the 1990 Gulf War, the economy wasn't as strong then as it is today. But boy, as that thing ended, oil prices came down strong. Obviously, the next leg was the U.S. tech revolution. And then after 2008, you also had a surge in the price of oil. Then you had almost a decade prior to COVID, a decade of a stronger U.S. economy supported by domestic capital spending. We had even more recently a surge in the price of oil. Obviously, back in 21, you went from $50 to $120. The U.S. economy stumbled slightly in the first part of 22, but then we took off again, supported by capital spending. So the thing that I keep reminding myself is that the economy is not just driven by one variable. It's not just oil. It's a function of monetary fiscal policy in general. And fiscal policy right now is underappreciated as a support in what I would call the right way, not through a boom in government spending, but companies have just seen $180 billion decline in their cash tax payments because they're incentivized to do capital spending. Deregulation is underway, and that's beneficial to small, medium-sized businesses. I hear it particularly from the banking system. Banks are easing lending standards. So right now, we for sure are at risk of the U.S. economy stalling out. Depends upon how long surge in the price of oil goes on. But net, this is a pretty strong economy.
How's the U.S. consumer doing with this backdrop here?
So the consumer is a little bit in a tug of war. On one hand, they obviously consumer confidence is down. We have a daily survey of consumer confidence, which is a little nuts, but it works, and it is down about 15 points. But it's still above where it was during the government shutdown, way above where it was during the COVID low, way above where it was during the GFC. So consumer confidence has gotten hit. But at the same time, we monitor your weekly retail sales data, and actually they, through mid-March, were on the stronger side. Mm-hmm. That is, again, consumer is driven by more than just gasoline. We have these tax refunds. To be sure, some of them are being eaten up by the higher gasoline prices, but the labor market, as I mentioned, if you look at unemployment claims, and I'm seeing more and more commentary on Bloomberg, on other news programs, that, wow, the labor market may not be as weak as I thought. Yep. Claims are indeed in a declining trend. That's helping the consumer.
So how do we think about inflation here? Because we did mention consumers are seeing it at the pump, a big increase, and we'll probably see it in other parts of the economy as higher energy costs flow through to, fertilizers and food and all that type of stuff. How do you think about inflation?
So first, energy spikes are a tax on the U.S. economy unless the Fed monetizes them, as they did during the 1970s. So
how do they do that? By just cutting rates?
Cutting rates, putting liquidity in the economy. Okay. You had double-digit money growth in the 70s, and you had double-digit money growth 21, 22, which is why inflation was indeed more sticky. But similar to a year ago, when you had the tariffs, almost a year ago, you had the tariffs. Our point then was it was a tax, and you did see one price went up, other prices went down. And so I think you're going to see the same thing today. Energy takes time to flow through to overall GDP, consumer spending. It very quickly impacts the CPI. So the March CPI will be bad, 0.6 or 0.7%. But again, it's a tax. I think as you go through the year, you could see other prices go down.
What's the state of American capitalism now? You've done so much thinking about the arc of the larger picture now. How do we incentivize ourselves to better productivity, better prosperity?
So I was actually in Europe last week, and I have a chart of U.S. productivity relative to Europe and the rest of the world. Yeah, no, it's.
Do we just work longer hours? As I look at Alexis Christoforous over there.
Thank
you.
And
The French have the same productivity we do. They just work less hours.
Yeah.
They're smarter than we are.
Actually, they don't. But we also invest in technology. I'm just sitting in this beautiful room, and again, I heard over and over again that Europe is indeed way behind from an investment perspective, from a technological innovation, embracing it, allowing creative destruction, which they don't allow, which we do. And so productivity has been an accelerating trend for about 10 years. We're back up to something close to 2.5%. And given all the R&D that's going on right now within corporate America, and being incentivized to do more R&D through the tax to the tax legislation, we think productivity growth can move up towards 3%. So the state of American capitalism with these capex incentives, with deregulation, we think is pretty healthy.
There's little to no population growth in this country these days. So for this economy to grow, can it grow because of increased productivity, maybe AI enhancing that?
Bingo. I mean, so much I hear from Wall Street, oh, the Fed has to cut rates because there's no labor force growth. And it's like, wait, potential GDP growth has two components. One is labor force growth, population growth, and the other is productivity growth. And they seem to forget about that. And productivity growth is boosting. All you have to do is look at the CBO data. CBO has data on potential GDP growth, and it has moved up to about 2.5%, which I don't hear anybody talking about, which suggests that real interest rates are about right. We don't need cuts in interest rates. Obviously, now the community is talking about higher rates. We don't think that either, simply because this is a tax on the economy. Fed policy is not overly aggressive. So at the end of the day, we think rates are about right.
So, I mean, again, if you look at the WIRP function on the Bloomberg terminal, the market kind of agrees with you. I mean, you get some people looking for a little bit of a rate cut, maybe a rate increase.
I don't know how to look up that. Help me, Paul. Where are we on that? We're looking at no rate cut
Nothing.
right now?
Yeah. I mean, kind of just
steady
as she goes, I guess. Yeah.
We had this call. It is. We had that call before the oil shock, before the war, because again, we have fiscal policy, which is stimulative to growth to the tune of about 1.5% of GDP, and it's the right stimulus. It's tax incentive. It's capex incentives. Second, the Fed has already cut rates 175 basis points. They're below nominal GDP growth, and then third, banks are easing lending standards, and so there is liquidity in the economy.
What do you think about this whole AI thing? How do you put that into context? Because prior to this war, that was it for the market. It was all AI. It's all we talked about. How do you think about it in terms of how big is it going to be for this economy?
So as Tom often reminds viewers, I've been in the business a long time, and I started in the 1980s when there were computers.
Yes.
Remember the first Hewlett-Packard calculator?
Oh yeah.
Only the rich kids had them.
That was in the 70s.
Okay.
In the 80s,
Excuse me.
I remember that too in high school. In the 80s, we went from a typewriter and a terminal to a computer, and it was IBM at the time, and that was very, very disruptive. I mean, accountants, etc. All of a sudden, you could do things very quickly on computers, and the productivity that created for the firm I worked at, CJ Lawrence, was tremendous.
Awesome.
It did make a huge difference. And over the past 45 years, every level of technological innovation has gotten smarter and smarter and more and more productive. And I'm excited about AI as far as, again, we're making these leaps and bounds in other countries. Sorry.
We should mention worldwide, it was Hyman Lazar. It was like a thing. It was like Red Sox pitching. There were two pitchers. So, and then you go on to Ed Yardeni. Does Nancy Lazar believe in Yardeni's bond vigilantes? Is this a market that's going to tell the president what to do?
I do believe in the bond market vigilante, big time. And I don't believe that the Fed's going to do financial market repression. And yeah, I think the bond yields have moved up some. I think that's quite frankly not the right call. I don't think inflation is a problem. I don't think the Fed has to raise rates, but at the margin, are these higher yields a little bit of a signal to Washington to be careful?
What is your biggest concern about this economy these days?
Well, it has to be in the uncertainty about what's going on in the middle in the Middle East. That is my to be sure, my single.
Do you sense that companies are holding back either like on capital spending or M&A, or I don't see it really.
I don't either. I mean, we just got these manufacturing surveys for the month of March from the regional Fed districts, and their capex components are like moonshots. And I think again, it takes a step back that there's incentives to do capex, and companies are doing it.